Okay, let's talk about the types of EMH. First of all, we talk about the assumptions of different types of EMH. First of all, the EMH assumption, the most important part is the freely available for all information. And do we remember what we talk about? The aim of the EMH is attempt to explain share price movements or how the share price movement relevant to information. Okay, is the most important or the aim of the EMH. So the all information is freely available is the first assumption based on the aim of it. Next is all investors can buy and sell the shares freely in the market without any significant cost. So in other words, no matter you are the institutional investors or you are small individual investors, you can just buy the share and sell the shares freely in the market. And the cost means the transaction cost. The transaction cost is very minimum or very low or even no transaction cost. And third assumption is any investor, no matter they are individual investor or institutional investor, they can buy and sell without the influence of the dominant buyer or seller. It means no matter you buy or sell one share or even 10 million shares, okay, you have no, you are not dominant or influence the market in terms of pricing, in terms of liquidity. So no one in the market has the power or the influencing power to influence the market. The fourth assumption is no one in the market or no one have the influence the market by any actions. Okay, for example, you have 10 million shares to sell. Okay, any pressure on the price? Okay, no, because no, you are not influencing the market by any investor actions. You are only one of many investors. So it means that in the EMH, it is a perfect market. And then we move on to discuss about the types of EMH. We have three basic types of EMH. The first type of EMH is the operational efficiency. It is the efficiency in which investors can buy and sell securities. Okay, what does it mean? It means every investor in the market can buy and sell securities with very low or low transaction cost. Okay, no matter you are, say, an individual investor holding 60% of company A shares. For example, company A issues 100 million shares, and you are individual X. You are an individual X, and you hold 60 million shares. You would like to sell 10 million shares, and for transactional cost, there's no transactional cost. Okay, no transactional cost. You can freely buy or sell securities that you want to do. And next is the pricing efficiency. It means the prices of securities should reflect the available information. So when all information released to the market, the price will reflect it. Say here is day 0. Okay, for example, it's the result announcement. And the share price, maybe like this. And when the results announcement on day 0, it gives a surprise to the market. The financial results is exceptionally good. So the prices of securities will be just going up, okay, to reflect the information available in the market. Okay, here, the pricing efficiency. And for C, it means the allocational efficiency. It means for both operational efficiency and pricing efficiency apply. Then the investors, they can put their funds, or they can allocate their funds to the companies, which the companies can offer the best rates of returns for a given level of risk. So it means that investors can freely invest the companies providing the best, they can accept the level of risk, and with that level of risk, the best rates of return can be given. Okay, so 3 basic types of EMH. We talk about operational efficiency. It means the transactional cost. And for pricing efficiency, we've talked about the fair value of the business should be reflected by the information released. And also for allocational efficiency, it means the investors' fund can be allocated to maximize their wealth or return. Okay, with level of risk given. Okay, so here is 3 types of EMH. And for the forms of efficiency, we have 3 basic forms as well. These forms of type. For the forms of efficiency, first is strong form efficiency. It means that for the share prices, okay, the share prices can reflect all information no matter is public released information or insider information. Okay, it's very important. For the strong form of efficiency, means the share prices can reflect all information, no matter it's the public released information or insider information. It means that all people in the market are fair. Because it is not quite impossible for those insider information to be reflected in the share price as well. So in reality, it is unlikely exists for the strong form efficiency. And next is semi-strong form efficiency. It means that the share prices reflect all public available information. Okay. Semi-strong form efficiency means the share prices reflect all public available information. Is it possible for insider trading because the insider information is not reflected in the share prices? So for example, if the insider obtain the information that they found should be good to the share price in future when it goes to the public, then they can, for example, buy the shares in advance in order to make profits later. If the corporate governance and also the disclosure requirements and also the regulatory bodies are not controlling well of these activities, okay, then it can happen. So it's very important for a market to prevent any insider trading, because it is not good for the other for the other investors with only access to the public information. And the third one is with form efficiency. The prices only reflect the information available in the past. In other words, some chartists